Welcome to the Deep Dive. Today, we're taking a closer look at a company that maybe doesn't always grab the headlines, but is, well, really quite an elite player in the industrial space. Nordson Corporation, that's NDSN.
That's right. And our mission today is to unpack a pretty complex situation. We've got this incredibly high-quality company, Nordson, but it's smack in the middle of a tough cyclical downturn.
Exactly. And it's colliding head-on with that reality. So Nordson, they're a stealth giant, you could say.
Definitely a fascinating case study in corporate resilience. They're leaders in precision dispensing, fluid management.
Yeah.
It sounds niche, but it's critical stuff.
And they've got this amazing distinction, right? The dividend aristocrat status.
Yeah, 62 consecutive years of dividend increases. Just think about that for a second. That level of stability.
It's huge. And for you listening, that 62-year streak, it tells you a lot about the predictability of their cash flow, doesn't it? Even when the economy gets shaky.
It absolutely does. It shows the core business model just works, pretty much regardless of the macro picture.
But here's the tension, the real question we're tackling today. This company, this high-quality compounder, is dealing with a serious cyclical slump. It's putting real pressure on their sales.
And that's the core analytical question, isn't it? You've got a company that historically has commanded a premium valuation precisely because of that stability.
Right.
So now, can its big strategic move, this huge debt-funded acquisition of Nordson Corporation, can that actually bridge the gap we're seeing now in organic growth?
And ultimately justify sticking with that premium valuation.
Exactly. That's what we need to figure out today. It's a balancing act.
Okay, so let's start with the basics. What exactly does Nordson do?
Well, they engineer and make products for precision dispensing and processing, really almost any kind of fluid you can think of.
Like adhesives,
Yeah.
coatings, sealants.
Yeah, powders, even really sensitive stuff like biomaterials. They don't just sell equipment, they sell precision. That's the key takeaway.
They're enabling modern manufacturing in a big way.
Absolutely. Think about it. If a company needs to put like a tiny, perfectly measured drop of conformal coating on a semiconductor chip, or apply a specific bead of adhesive to bond the elastic in, say, a disposable diaper, they're probably using a Nordson system. It's all about that precision.
Got it. And the current headwind, this downturn, it's not theoretical. It's showing up in the numbers.
Oh, yeah. The source material makes it clear. Fiscal 2024 saw, what was it, a 3% organic sales decline overall? Which isn't great, but maybe manageable.
But then Q1 of fiscal 25 hit.
And that's where it got sharp. A 9% organic decrease year over year. That's a really significant drop for a company of this caliber. Brutal, like you said.
And what's driving that 9% drop?
It's mostly weakness in global electronics and just broader industrial capital spending. You know, when CEOs see higher interest rates, economic uncertainty.
Right. The first thing they pause is buying new equipment. CapEx gets deferred.
Exactly. So facing that storm, management decided, okay, we need to pivot hard.
And that pivot is the Nordson acquisition, a massive deal.
Around $1.2 billion, all cash, for Nordson Corporation. And you're right, this isn't just, a bolt-on acquisition. It's a very deliberate move.
Countercyclical, trying to shift the mix.
Yeah, significantly boosting their exposure to the medical market, which tends to be much less cyclical. It's a portfolio shift.
So this is a really high-stakes moment for them.
It really is. We're looking at this clash, this meeting point between long-term quality and short-term economic pain.
And for anyone listening who tracks industrial health globally,
understanding how a company like Nordson, known for being durable, manages a sharp correction while executing a huge acquisition like this, well, that's the real value here, I think. That's what makes this deep dive interesting.
Okay, so we've set the stage.
Yeah.
The current crisis, the big strategic response. But before we dig into the damage, let's talk about their defenses, their armor, so to speak.
Right. What makes Nordson so durable in the first place? Why does it usually get that premium valuation even when facing a 9% organic dip?
It starts with their core competitive moat.
Right.
Built around selling that precision we talked about.
Yeah, the value proposition is key. Nordson's tech isn't just a nice-to-have feature. It's often mission-critical for their customers.
How so?
Well, it delivers really exacting accuracy, precise process control, and that translates into huge operational benefits for the customer. It's not about saving pennies on a widget.
It's bigger picture.
It's about reducing material consumption, maybe expensive adhesives or, gold wire in electronics. And it's about eliminating defects, which saves potentially millions in scrap, rework, recalls.
And that focus on precision leads us straight to the core of their financial stability.
Razor.
It's a razor blade model.
Ah, yes. The classic model, the initial machine sale, the CapEx, that's just the start.
Can you break down how that looks financially for Nordson
Yeah.
based on the source data?
Yeah, the numbers are quite clear in the materials. In fiscal 2024, only 43% of their total revenue came from selling the initial systems, the capital equipment. That's the razor.
Okay, less than half.
Right. The other, much larger chunk, 57% of total revenue came from ongoing, high-margin sales of proprietary parts, nozzles, filters, consumables, you name it, the blades.
Wow, 57%. That's a big number for recurring revenue.
It is, and that's supposed to be the great stabilizer, right? The anchor for the whole operation.
But here's the challenge then, for you listening. If nearly 60% of revenue is recurring and stable, why did Nordson see such a sharp overall downturn? That 9% organic decline in Q1. Shouldn't the consumables have cushioned the blow more?
That's a great point, a really important nuance. It suggests that even that consumable revenue isn't completely bulletproof.
It stabilizes the base, maybe. Slows the fall.
Exactly. It stabilizes the denominator, as you say. But if new system sales, that 43% just fall off a cliff because everyone's deferring CapEx.
Then even 57% stability can't stop the total number from going negative.
Precisely. The consumables slow the fall, but they don't defy gravity when the whole industrial world breaks hard.
But they do provide that predictable foundation of cash flow, right? That's what anchors the company.
That's the key. It allows them to keep funding the dividend, that 62-year streak, and make strategic moves like the Atrion acquisition, even when the capital equipment side of the business is, well, frankly, collapsing temporarily.
Okay, so the model helps, but it doesn't make them immune. Now, let's talk about maybe their strongest defense. The high switching costs, the lock-in.
Yes. This is arguably their biggest asset, and you won't find it itemized on the balance sheet.
How does it work in practice?
Well, think about it. Nordson systems get deeply embedded into customer production lines. Imagine a huge factory churning out hundreds of thousands of, say, smartphones or medical devices every single hour.
Yeah.
Their dispensing system might be just one small part of that massive line, but it's absolutely critical.
And the cost of the Nordson system itself is probably pretty small compared to the value of the final product, like that expensive smartphone.
Exactly. But the cost, if that system fails, it's catastrophic. You're talking line stoppages costing millions a day, product defects leading to massive recalls, or even regulatory failures if it's a medical device. The stakes are incredibly high.
So, trying to switch to a competitor, even if they offer a slightly cheaper machine, it's just not worth the risk.
It's usually prohibitive. Think about the process. You'd need weeks, maybe months of engineering time, rigorous testing, requalifying the entire line, getting new certifications, retraining operators.
And all that time, you're risking defects on every single unit coming off the line, potentially shutting down production entirely.
Yeah, the cost of that downtime, the risk, it just creates enormous inertia. Once a Nordson system is designed in, qualified, and running smoothly, especially in something critical, that customer is effectively locked in.
And the need for those proprietary consumables just keeps reinforcing that lock-in over time.
It's a very powerful barrier to entry, much stronger than just having, say, slightly better pricing.
We should probably also mention the other things that strengthen this moat, according to the source materials.
Right. There's genuine tech leadership they mentioned, over 95 active patents, which is substantial.
And the global network.
Yeah, that's critical too. They have this difficult to replicate direct sales and service network in over 35 countries. They don't just rely on distributors.
They're on the ground providing expertise.
Exactly. They're working directly with engineers on the plant floor, solving application problems. That builds incredibly sticky relationships and reinforces the moat even further.
Okay, so that's the foundation. Now, to really understand how this current cyclical storm is hitting them, we need to look inside the business at the different segments.
Absolutely essential. They're all unified by that precision fluid management theme. But their performance, their profitability, their cyclicality, it varies quite a bit.
It shows you where the money's really made and where the biggest headaches are, cyclically speaking.
Precisely. It's not a monolith. It's a portfolio, and you have to understand the pieces.
Let's start with the biggest piece, the profit engine. Industrial Precision Solutions, or IPS, the industrial business.
Right. IPS is the anchor. It accounted for, 55% of revenue in fiscal 24? Around $1.4 billion.
And what kind of stuff does IPS cover?
It's broad. Dispensing, coating, processing equipment. Think consumer non-durables like packaging or the high-speed assembly of things like diapers, feminine hygiene products, also automotive assembly, general industrial manufacturing. It's core industrial stuff.
And this is where the really big profits are.
Mhm.
The source material highlights a 34% operating margin. That seems incredibly high for an industrial segment, especially now.
It is incredibly high. 34% is fantastic. It comes down to basically volume and entrenchment. These systems run in huge continuous production lines where tiny efficiency gains matter a lot.
And the consumables.
The proprietary consumables, the blades are high volume. They're non-negotiable because the machine won't run without them. That drives really strong pricing power and scale efficiencies that you maybe don't see as much in the other segments.
So it's resilient because of that huge installed base.
Very resilient. It's the bedrock of their profitability.
Okay, next up is the segment they're pushing into hard with the Atrion deal. Medical and Fluid Solutions, or MFS, the medical segment.
Right. MFS was about 26% of revenue in fiscal 24, roughly $695 million. And that's before adding Atrion.
And what's their focus here?
Highly engineered, single-use plastic components. Things like specialized tubing, catheters, medical balloons, fluid connectors, mostly sold to the big medical device OEMs.
And this segment has some nice tailwinds, right? Things that aren't tied to the usual industrial cycle.
Definitely. You've got the aging global population, which drives healthcare demand, and the big trend towards minimally invasive surgery that requires more and more sophisticated disposable components.
Less cyclical drivers.
Exactly. And unlike, say, buying a new assembly line, the purchasing cycle here is more driven by things like regulatory approvals, new product launches from the OEMs, and patient outcomes. It's a different rhythm.
Still pretty profitable, though.
Oh yeah, a very healthy 29% operating margin. And it's worth noting, this segment relies heavily on specialized manufacturing. They mentioned 3 FDA-registered facilities. That points to higher regulatory hurdles, stricter quality control.
Which acts as another barrier to entry and helps justify those strong margins and the relative stability.
Precisely.
Okay, finally we get to the segment that gives investors the wildest ride. Advanced Technology Solutions, or ATS, the electronics segment.
ATS is the definition of cyclicality. It was about 19% of revenue in fiscal 24, around $696 million. This is where the really advanced stuff lives.
Like what?
Automated precision dispensing, surface treatment, complex inspection equipment, all geared towards the electronic supply chain. Semiconductors, printed circuit boards, mobile phone assembly, that whole ecosystem.
So this is basically a direct play on global tech capital spending.
Absolutely. It's tied right to the hip of the semiconductor cycle with its notorious boom and bust dynamics.
Which explains why it has the lowest margin of the 3.
That's right, around 19% operating margin. The technology here is maybe the most cutting edge, dealing with incredible miniaturization, but the competition is intense.
And the customers are huge.
Yeah, the big semiconductor fabs, the giant electronics manufacturers, they have an enormous buying power. So when the tech cycle turns down, ATS feels the pain fast and hard. It's easily the most volatile part of Nordson's portfolio.
So putting it all together, the idea is that the stability and high margins from industrial and medical are meant to smooth out those wild swings from electronics.
That's the structural plan, yes. High margin stability offsetting high growth but high volatility.
But as we're seeing now, when the entire global industrial base hits the brakes on CapEx,
then even the stable parts feel the pressure. The model gets tested.
Okay, let's connect that segment structure directly to the current uncomfortable reality. Management has these ambitious long-term targets, right? 6-8% average annual revenue growth.
Yeah, under their Ascend strategy. And the recent performance is, well, a long way from that goal right now.
That gap is significant. The full fiscal 24 decline was 3% organically.
Which already signaled a slowdown.
But then that Q1 fiscal 25 number, the 9% organic drop year over year, that really showed the pressure wasn't easing, it was actually deepening.
And that's why the premium valuation gets questioned, right? Because the growth part of the story is just absent, temporarily at least.
Let's drill down into the segments again. How did this downturn hit the profit engine, the big industrial segment, IPS?
Even IPS, which is usually pretty robust, felt a definite chill. It was down 5% organically in Q4 of 24.
Which tells you?
It tells you this is broad weakness in industrial capital spending. It's not just one niche. Customers who might normally buy a new high-speed dispensing line are just deciding, you know what, let's squeeze another 6 months out of the old Nordson machine. It's pure deferral.
Okay. What about the medical segment, MFS, the one they're strategically leaning into? It must have held up better, though maybe not perfectly at first.
That's exactly right. There's nuance there. MFS actually posted a 3% organic decrease back in Q4 24. They cited some temporary softness in, I think, interventional
So
solutions.
not totally immune.
Not totally, but the key difference is, unlike industrial capex, which can be deferred for long periods, medical demand tends to be driven by more fundamental things patient needs, demographic
So
shifts.
it should bounce back faster.
That's the expectation. And encouragingly, the recent Q3 25 results, they showed a 4% organic increase in the medical segment, even excluding divestitures. So it does look like it's stabilizing and getting back on its secular growth track.
Good sign. And then there's the wild child.
Yeah.
Advanced technology, the electronics segment, ATS. This is where we expect the drama.
Absolutely. ATS is super sensitive to inventory swings, semiconductor cycles, all that stuff. It managed, interestingly, a modest 4% organic growth in Q4 24 after a period of real weakness.
Okay.
But here's the really interesting bit, maybe a forward indicator. In Q3 of fiscal 25, just recently, ATS posted a remarkable 15% organic sales increase.
15% after all the tech bloom.
Yeah, driven apparently by a rapid rebound in demand for electronics dispensing equipment. That sudden, sharp surge. We need to remember that when we get to the final assessment. It's significant.
Definitely. Beyond the segments, there are the bigger macro pressures, right? High interest rates globally, just crushing capital equipment purchases.
That's the main headwind, no doubt. Doesn't matter how good your execution is if central banks are tightening screws everywhere.
And geographically, it's a mixed bag, too.
Yeah, it's a fascinating picture of regional differences. The source material noted that for the 9 months ending in July 25, Asia Pacific was actually a major bright spot, up 16.2%.
Wow. That must be tied to that electronics rebound we just talked about.
Almost certainly. Given how much electronics manufacturing is concentrated there, it shows pockets of strength exist.
But that strength is being offset by weakness elsewhere, particularly Europe.
Correct. Europe was highlighted as a drag, down about 2.6% over the same period. That reflects the, generally more sluggish industrial and manufacturing climate over there right now.
So Nordson's global footprint helps balance things, but it means they're juggling very different economic speeds simultaneously.
Exactly. It's complex management challenge.
Okay, so facing this really complicated storm pockets of strength, areas of weakness, macro headwinds management didn't just sit back. They launched this big strategic pivot framed under the Ascend plan.
Right. Ascend is their roadmap for 2025 through 2029. And the targets are, well, pretty ambitious given where they are right now.
What are they aiming for?
They're targeting 6-8% average annual revenue growth, and maybe even more importantly, 10-12% average annual adjusted EPS growth.
Okay, 6-8% revenue growth, coming off negative organic numbers. How do they possibly get there? What's the plan? What's the growth algorithm look like?
Well, the algorithm they laid out is pretty balanced, and importantly, it openly includes M&A. They expect about 3-4% of that growth to come from organic efforts, R&D, market expansion, better execution through their internal systems.
Okay, half of it organic.
But the other half, the other 3-4%, is explicitly expected to come from M&A. Mergers and acquisitions are baked right into their core long-term growth plan. It's not just opportunistic.
And the giant centerpiece of that M&A strategy, the deal that really changes the company's profile, is Atrion.
Absolutely. The Nordson Corporation deal. We need to dig into this one.
Tell us about Atrion and why this $1.2 billion deal carries so much strategic weight.
Okay, so Atrion makes proprietary medical products. They focus on things like infusion tech, cardiovascular applications. They did about $169 million in revenue in 2023.
And Nordson paid $1.2 billion all cash.
All cash. The primary strategic reason, as we've touched on, is clearly diversification, moving the needle significantly towards those less cyclical medical markets.
But it's complex, right? This isn't just buying another company that makes a slightly different type of glue dispenser. What are the real integration challenges here? Merging this industrial giant with this specialized medical device component maker.
That's a really critical point. The market sometimes just looks at the deal math, the EBITDA multiple, but you're merging fundamentally different business cultures and operational needs.
How so?
Well, the medical segment, especially with Atrion added, operates under incredibly strict regulatory controls. Think FDA oversight, rigorous quality management systems. That's paramount. Industrial sales, while they need precision, generally have faster product cycles, less intense regulatory burden.
So integrating Atrion isn't just about finding cost savings. It's about adopting, maybe even elevating, this culture of intense regulatory compliance across the entire expanded medical segment.
Exactly. And ensuring they retain the specialized talent from Atrion who are used to navigating that complex medical device world. That's crucial.
But the strategic logic is clear on paper.
Yeah, the rationale is materially boost the scale of MFS, reduce the company's overall earnings volatility, get more exposure to those nice secular medical trends like aging populations. Management also expects it to be accretive to earnings pretty quickly, especially with synergies.
What kind of price did they pay, valuation-wise?
They valued it at about 15 times Atrion's estimated 2024 EBITDA, including those expected synergies. So not cheap, but potentially justified if the strategic rationale plays out.
Okay, so M&A is a big part of the growth story. What about the internal execution piece? How do they drive efficiency and fund growth internally?
That comes down to their continuous improvement system called NBS NextDT, Nordson Business System NXT.
What does that do?
It's basically their internal toolkit for systematically finding the best growth opportunities, allocating capital effectively, and driving margin expansion. It promotes a kind of decentralized entrepreneurial approach in the divisions, but with strong central accountability for performance.
And that's how they managed to hit that record 32% EBITDA margin, even while sales were shrinking.
That's a big part of it, yeah. Relentless focus on efficiency and prioritizing resources.
Okay, finally, let's circle back to the organic growth side. Assuming the cycle eventually turns, what are the big secular tailwinds that should help them get back towards that 3–4% organic target?
Well, there are several powerful trends they're plugged into. First, just the broad global push for more automation. Industry 4.0 that naturally drives demand for their automated dispensing and quality control systems.
Makes sense.
Second, in electronics, the relentless drive for miniaturization, smaller chips, denser packages requires ever more precise dispensing from their ATS systems. That forces upgrades.
What else?
Third, vehicle electrification is a really big one. Building EVs requires totally new dispensing applications for battery packs, thermal management, bonding lightweight structural components. That's a significant new market opening up.
And then just the general advancement in medical tech feeding the expanded MFS segment.
Exactly. New procedures, new devices that should continue to fuel demand there. So the argument is, yes, there's a cyclical trough now, but the underlying long-term trends are still very much in their favor. They're structurally positioned to rebound.
Right. So the foundation seems solid. Let's talk about the financial profile itself. This is where Nordson really stands out as, an elite company, right?
Absolutely. The metrics here are genuinely exceptional by almost any industrial standard. Let's start with profitability and just the quality of their cash generation.
Okay.
The numbers are pretty eye-popping. Between 2019 and 2024, they averaged, get this, a 54.2% gross margin.
Wow, over 50%.
And an average EBITDA margin of 30.1%. But wait, you mentioned earlier they hit a record 32% EBITDA margin in fiscal 24, right in the middle of this downturn.
Yeah, that's what the source material says.
How is that even possible? What really explains that kind of margin resilience when sales are falling?
I think it comes back to that razor blade model. The high margin consumables, the 57% of revenue, covers a lot of the fixed costs.
Ah, okay.
So when they do sell a new system, even fewer of them, a disproportionately large chunk of that sale drops straight to the bottom line, to the margin, plus that relentless cost control through NBS NXT you mentioned.
That makes sense. The model is just built for margin resilience, and that strong margin performance leads directly to incredible cash flow, right? The quality of the cash.
Exactly. That's maybe the most impressive metric.
Yeah.
From 2019 to 2024, they generated over $2.8 billion in free cash flow before paying dividends.
That's a lot of cash.
But even more critical is the conversion rate. Their free cash flow conversion averaged 113% of net income over that period.
Okay, hang on. For listeners, what does a free cash flow conversion rate over 100% actually mean? Why is that so good?
It basically means the actual cash hitting their bank account is consistently higher than the profit they report on their income statement.
So the earnings are super high quality.
Extremely high quality. Very reliable. It means their earnings aren't getting artificially inflated by accounting rules or bogged down by things like huge depreciation charges or needing tons of cash tied up in inventory or receivables working capital.
Got it. So the cash is real and it's abundant.
Very abundant. In fact, their most recent quarterly results, Q3 fiscal 25, showed an FCF conversion rate of 180%. It's just a torrent of cash being generated.
Yeah.
And that cash engine is what funds everything else.
Which leads us nicely into how they use that cash, their capital allocation priorities.
Right. Management seems pretty disciplined here, based on the source material. They have a clear hierarchy.
What's number one?
Priority one is funding organic growth. So R&D for new tech, capital expenditures to improve manufacturing, that kind of stuff. Internal investment first.
Makes sense. What's next?
Priority 2 is returning capital to shareholders. That's where the dividend comes in. And also routine share buybacks.
Keeping the owners happy.
Exactly. And then priority 3, with whatever cash is left over, is strategic deployment. That means big M&A deals like Atrion, and then using subsequent cash flow to pay down the debt from those deals.
A logical flow. Fund the business, reward shareholders, then pursue strategic growth and deleveraging.
Focusing on those shareholder returns for a moment, that 62-year dividend streak really stands out.
It's the cornerstone, isn't it? That dividend aristocrat status isn't just a label. It signals deep management confidence in the long-term cash generation of the business. They just raised it again by 5% in August 25.
And they do buybacks too.
Yeah, they actively use buybacks. They just approved a new $500 million share repurchase authorization in Q3 25. At the very least, that helps offset dilution from stock options and signals they think the stock is reasonably valued.
Okay, so strong financials, disciplined allocation. But now we have to talk about the big shift, the new risk factor, the balance sheet impact of the Atrion deal. Nordson used to be known for being super conservative financially.
They really did, a fortress balance sheet. End of fiscal 2022, their leverage ratio debt to EBITDA was only 0.7x. That's incredibly low, gives you immense flexibility.
But Atrion changed that picture dramatically.
Yeah, the $1.2 billion purchase was funded entirely with debt, 100% debt financed.
So that significantly ramps up the company's financial leverage, at least for now. And that introduces a risk for investors who like that old conservative profile.
It absolutely does, no question. The market, the investment community, is definitely watching the pace of debt reduction very closely now.
What's the calculated risk they're taking?
The bet is basically that their free cash flow engine is so powerful, so reliable, remember that 113%, even 180% conversion, that they can comfortably service the higher debt load and pay it down relatively quickly, maybe over the next, say, 2 to 3 years.
So sacrificing that short-term balance sheet strength.
For a long-term strategic goal, reweighting the portfolio towards the stability of the medical market, it's a deliberate trade-off.
Okay, that brings us to the final act. Valuation, risks, and the overall assessment. We've established Nordson is high quality, throws out tons of cash, but it's in a cyclical dip, and it still trades at a premium.
Right. The PE ratio you mentioned, around 29 compared to a peer like ITW, maybe closer to 23. That's a noticeable premium, so we have to tackle that valuation debate head on.
Let's start with the bull case. Why should the market look past the current negative growth and keep paying that premium?
Well, the argument is that sophisticated investors can see this as temporary. They look through the cycle. The premium is justified by all those structural advantages we discussed. The best-in-class margins, that incredible free cash flow conversion, the strong moat from switching costs and tech leadership.
And the Atrion deal actually strengthens the bull case long-term.
Potentially, yes. Because future earnings, once things normalize, should be more stable and predictable thanks to the bigger, less cyclical medical business Atrion brings. It enhances the quality mix.
Okay, fair enough. Now, the other side, the bearish argument. Why might that premium be fragile right now?
The core bearish point is that the premium valuation requires growth. When you see organic numbers like -9% in Q1 25, that directly attacks the growth pillar of the investment thesis.
So the stock becomes vulnerable.
Highly vulnerable to what's called multiple compression. If the downturn drags on, or if investors lose faith in a quick rebound, the market might decide Nordson doesn't deserve that 29 PE anymore and push it down closer to its peers, even if earnings themselves don't fall much further. The valuation itself shrinks.
Okay, let's crystallize the key risks investors need to keep an eye on. We know the cyclical risk is the big one, near term.
Yeah, the external risk is basically a deeper or longer recession in their key markets, electronics and general industrial. Something that keeps CapEx frozen for longer than expected. That's largely out of management's hands.
Then there are the internal risks, specifically tied to pulling off the Atrion integration.
Huge risk there. M&A integration is always tricky. If they fail to get the cost savings or the revenue synergies they projected.
Or if they mishandle that cultural integration we talked about, the industrial versus the highly regulated medical side.
Exactly. Or if they fail to retain key Atrion talent who know the medical market inside out. Any of that could mean the deal doesn't deliver the expected earnings boost, undermining the whole rationale.
And the financial risk is now higher too because of the debt.
Yep. The increased leverage just makes them inherently more vulnerable if something unexpected goes wrong. Their FCF is great, but they need to execute on paying down that $1.2 billion debt reasonably quickly to regain flexibility.
Any other big risks?
Well, we should mention geopolitical risk. With almost 30% of sales coming from Asia Pacific, they have significant exposure there. Renewed trade tensions, particularly with China, or unexpected regulatory hurdles could definitely impact their strongest growth region.
Okay, so putting all those risks together, what's the final assessment? Is Nordson a potential value trap right now, trading at a premium while growth is negative?
I'd say no, probably not a value trap in the traditional sense. The risk of catastrophic permanent capital loss seems extremely low
Why?
because the underlying business model is just so fundamentally strong. That 57% recurring revenue provides a huge cushion. The profitability is elite. The technological moat is real. This isn't a company likely to go bust.
So the main risk isn't about survival, it's about...
It's mainly about price volatility and that valuation compression risk during these cyclical troughs. It's a fantastic quality company, no doubt. But right now, its stock price is highly sensitive to the market's perception of when the industrial cycle will finally turn positive again. Timing is everything.
Okay, let's wrap this up. This deep dive really highlights Nordson as a top-tier industrial compounder, making a very bold, counter-cyclical move.
Yeah, they're consciously sacrificing some of that pristine balance sheet strength in the short term
By taking on significant debt for Atrion.
to achieve a long-term strategic pivot towards the stability of the medical sector, all while navigating this really painful cyclical downturn in their traditional core markets.
But the underlying strengths are still there. The elite margins, the fantastic cash flow, that incredible 62-year dividend record.
All anchored by that powerful razor blade model, the 57% recurring revenue. The Atrion move is designed to make them even less reliant on those volatile industrial capex cycles in the future.
Which brings us perfectly to the final provocative thought we want to leave you, the listener, with. Remember that data point about the advanced technology segment, the electronics business.
Right, the most volatile part of their portfolio. It posted that sudden, really strong 15% organic sales increase in the latest quarter, Q3 fiscal 25. That's a serious positive turn.
So here's the question. Does that sharp, localized rebound in their most sensitive end market maybe hint that the cyclical trough is already ending, maybe faster than people thought?
And if the cycle is indeed turning sharply upward right now, starting with electronics and potentially spreading to the broader industrial sector soon.
Was the massive debt-funded Atrion acquisition, bought at a premium valuation, the absolute right move at the right time? Or did they potentially pay up to solve a cyclical problem that the market recovery was about to fix for them anyway?
It forces you to really consider the timing. Will that electronic surge prove to be a leading indicator for the rest of their business in the coming quarters? Or was it just a temporary blip?
That timing, as you said, seems to be the whole ball game for Nordson right now. Definitely something to watch.
Absolutely.
Until next time on The Deep Dive.